Welcome everyone to Preparing for Retirement. Today we'll be talking about a bunch of things in terms of how you want to think about what to prepare about for retirement and some changes that you'll experience at that time. Let's see, so I've got the screen shared. So I work for a company called Multnomah Group. We do retirement plan consulting and are probably consulting on your company's retirement plan as well. My role at the company is to do educational content like this, as well as to meet one-on-one with people, analyzing their goals and kind of figuring out what might work best for them. Things we'll be looking at over the course of today are considerations for retirement and what you should be expecting, retirement cash flow planning, how that plays into Medicare and Social Security, some investment considerations in retirement and how that's different from while you're working, a little bit about taxes during retirement, and a little bit about estate planning as well. We will be keeping things pretty general in this presentation. We can't cover everyone's specific situations, but questions are appreciated. Just try and keep them general so that they're applicable to more people. There is a Q&A feature available, so you can use that to add any topics as we go through, and then as I get to the end of each section, I'll address questions. And try and, as we go through the presentation, it'll be a lot of information. Try and focus on one or two key pieces of information and then an action that you might take from that information. So as we look at what to expect in retirement, we actually want to start kind of qualitative. This is something that often gets missed when people are thinking about retirement planning. But it's a very important piece of the puzzle. So you want to think about, when you want to retire, what does retirement mean to you? What are you thinking about going into retirement? What are you picturing happening when you retire? You're going to have a lot of time that needs to be spent a different way. So how do you envision that looking? What does an ideal week look like for you? Try and be as specific as possible, thinking about what you want to do with your time, who you want to be doing those things with. Think about what do you want to be doing at 10 a.m. on a Tuesday morning, because there is a lot of that gets missed when people are thinking about it. You also want to think about where you want to live. A lot of people want to stay where they are and retire where they are, but you might have family elsewhere or other things that kind of a job has been holding you back from being in a different place. So you'll want to think about the implications of living in a different place if you want to be living somewhere else. What does the tax situation look like in a different state? Pretty much every state has different situations as far as like what income taxes, sales taxes, property taxes will look like. So you want to think about that ahead of time. As well as, I just want to mention, if you're thinking about retiring outside the US, I don't know if this presentation will be super helpful for that decision. That's kind of outside the scope of things. Generally, that's a situation where you'd need a tax attorney that understands the situation where you live right now, as well as where you're moving to kind of help you make decisions and figure out what that would look like. As we move into quantitative questions, one thing is, how long do you think retirement will last? This is kind of a two-piece thing, which one is like, how long do you expect to live? And the other is, when do you expect to start retirement? This is something there's always going to be some uncertainty about. but it's important to quantify it to some extent to make the decision. How much money do you expect to need in retirement? Different people's retirements can look extremely different in terms of spending. Some people want to travel more. Some people are looking to leave a legacy. You might have different healthcare needs. Maybe some people might want to buy an RV and be going camping all the time in retirement. And for other people, maybe they don't need a second car anymore and it's actually lowering expenses. So thinking about those kinds of things with respect to the retirement you picture can help us figure out how much money you actually need to live in retirement. And then the last question, which is a lot of what we'll be trying to help address today, is where will the money come from? Generally, sources where you can take money from are going to be retirement accounts like your 401k, 403b, Social Security, savings that you have in bank accounts or taxable investment accounts, pensions. And then for some people, retirement actually means not completely exiting the workforce, but just that they want to do something different. So there may still be wages involved in your retirement or a side hustle or real estate or things like that. So when considering when we want to retire, we're trying to answer like how long we think retirement will last. And the earlier that we want to retire, that means we have less time to accumulate funds, including we have less time for our investments to grow before we need to start tapping into them. And then that also means we have more years that the money needs to last. If you're planning to retire before 59 and a half, you've got to think about where you can get penalty-free money from accounts, because a lot of retirement accounts you can't get to until 59 and a half without getting a 10% penalty plus having to pay taxes on your withdrawals. Social Security isn't available until age 62 at the earliest, and it's almost never right to start it that early. I won't say never, but it is rarely correct to start Social Security at age 62 because you'll lower the amount of benefit you get for the rest of your life. Another thing you want to be considering with early retirements is what you're going to do for medical care between when you retire and age 65, when you can get on Medicare. For a lot of people, this just means understanding what the premiums and expenses associated with a public healthcare plan will be. And that's just something you need to factor into your cost equation. Another thing, if you have access to, or you or a spouse has access to pensions or annuities, sometimes you can't start drawing on those until a certain point in time. There are some exceptions to that, but generally speaking, you'll just need to be a lot more thoughtful about how you get money before age 60, essentially. If you're thinking about a delayed retirement, you get some of the opposite side of this. You have more time to accumulate funds, more time for that funds to grow while you're not tapping into it, and then fewer years that you need the money to last. So, there's kind of an inherent trade-off here between retiring early, meaning less spending while you're working and or in retirement. And Social Security, I talked earlier about how we don't generally like to take it at 62. Taking it at 70 results in the highest benefit amount, at least currently. And so if you can live off other assets and wait until 70 to start claiming Social Security, that tends to give you the best hedge against outliving your money. You'll get the highest benefit throughout your lifetime if you live quite a while, usually past your mid-80s. Another thing to consider that I think can be very helpful is thinking about different phases of retirement or scaling down and working part-time, often what you really want to do in retirement could still earn some income. So continuing to plan to earn some kind of income can be very beneficial financially, but also non-financially. So obviously you get more money while you're working. This can allow you to delay Social Security and get that larger benefit for the rest of your life. Can also give access to important benefits like healthcare, the ability to still have access to a retirement plan that you're contributing to, dental, vision, those sorts of things. But another thing that often gets missed is that there are pretty large non-financial benefits from continuing to work. A lot of people, get non-financial things out of their work. A sense of purpose, fulfillment, community, all of these sorts of things often, it's such a big part of the meaning of our life, what we do for employment. And, it can help to figure those things out more gradually than just suddenly stopping work and being cut off from all of those things that you used to have. So do we have any questions about the content so far? Looks like several more people have joined us, so feel free to put questions in the Q&A. That's how you can ask them in this webinar setting. All right, and I'll check in again as we get to the next section. But the next question that we want to try and answer, our second big question here is how much money do you expect to need? So we're focusing on these three steps of the planning process here, estimating income, considering factors like inflation, and then other income sources that we might have. So looking at budgeting for retirement, generally speaking, you will want something between 70 to 100% of your pre-retirement spending. That's a pretty big range, and it depends on a bunch of things. But as you're thinking where you fall in that range, what we're really trying to figure out is what expenses are going to be changing in retirement. So one is maybe you have a paid for house and housing costs will be lower. One of the other big ones is you're not saving for retirement anymore. So if you're thinking about 100% of your income, but you were saving 15% of it, if you have enough by the time you retire, you don't need to be saving that 15% anymore. So that kind of would put you down to a need of 85% right there. If you're thinking about early retirement, healthcare costs may increase depending on your situation. Like Medicare is often not that terribly expensive, so healthcare costs could decrease as well. So understanding those things. Are there specific things that you want to be doing once you have more time? Travel's a big one for a lot of people, but also maybe just more day-to-day hobbies that you'd like to pick up, things that you didn't have time for while you were working, home projects. Do you want to be helping out family as part of your retirement plan or charitable giving, things like that? Make sure to include a buffer and some costs for unexpected life events. If you're not budgeting anything for home maintenance in retirement, I think this is a big one that gets missed. Generally speaking, you want between 1% and 4% of your home's value per year for maintenance, and that sounds like a huge number when you add up what that is. But the home maintenance comes in lumpy expenses, right? It's you need work done on your foundation. Sometimes that's major. You need a roof replaced. You need a furnace replaced. Eventually, pipes need to be replaced in your house. all of those things tend to come in big lumpy expenses. So you want to make sure that's accounted for and you're not just thinking you own your home free and clear and it's just property taxes from here on out. And you want to make sure that you do expect some degree of inflation in your costs as well. So try and list out as many of these expenses as you can, be specific, and especially in terms of the things that are changing, try and be as specific as you can about how those will affect your costs in retirement. Now we want to look at Medicare and how healthcare costs work in retirement. Medicare coverage starts at age 65. You can delay starting Medicare if you're still on employer-based insurance. So if you're working past 65, you can delay it, but you want to make sure to sign up for Medicare on time. There are penalties if you don't sign up on time that will make it more expensive throughout your entire life, not just in the short term. It's not just a quick fee that you pay. You'll start getting notifications for Medicare around age 64. So you will get notices, but make sure that you do get signed up right around when you're 65. There's a little grace window ahead of time and after. I can't remember if it's 3 or 6 months, but there is a period of time around where you are able to sign up. So it doesn't have to be on your 65th birthday. Sometimes basic Medicare doesn't cover everything you need. So either looking at Medigap policies or Medicare Advantage plans will often give you a more total coverage that you want. So you can, once you are on Medicare, you can work with whoever you like healthcare through and figure out what kinds of plans you'll basically be able to get on a plan with them that's heavily subsidized by Medicare in general. One thing to note is Medicare will not pay for long-term care needs. So if you need, nursing or memory care at end of life, that is something that Medicare won't cover. Medicaid may cover some of those things, but it has very strict asset and income parameters. And so you'll generally have to exhaust all of your assets before Medicaid will start covering things, which is not the plan most people want. And finally, we'll move on to big question number 3, where will the money come from? So as we're looking at sources of income in retirement, Social Security is a big one for a lot of people. Pensions are also a pretty big one for a subset of the population. Wages from part-time work, as I mentioned. I'd really encourage people approaching retirement to consider some form of part-time work because, as I said, there's more than just the financial benefits of some part-time work. It can really help you ease in and figure out what to do with your time and how to make sure you have community and connection and purpose throughout your retirement. Another thing that you'll want to do is access any personal savings or investment you have. Maybe you have annuities or life insurance policies with cash value, retirement accounts like your 401k, 403b, 457, or IRAs. You can access money from those. And then finally, you might just have, bank accounts with cash or taxable investment accounts that you can access money from. So Social Security is generally, I'd say for a very small portion of the population, will it be a complete retirement plan for you. We're not expecting it to go away, but there are, I'd say it's more realistic the benefits might be reduced at some point in time. But that's sort of all unclear from a regulatory point of view, but it's a very popular program. I don't think Congress would actively get rid of it. I view that as very unlikely. when thinking about how much benefit you get from Social Security, you can claim as early as 62 for the minimum benefit on a monthly basis, or wait until age 70 and claim the maximum benefit on a monthly basis. There is a concept when you look at your Social Security statement of full retirement age. This is 67 for people born after 1960. So for most people, unless you're retiring in the very near future, that probably is you. Every year that you wait to claim, you'll get an 8% larger benefit, and you have control over when you're claiming. So don't think of needing to claim Social Security as tied to the year that you retire from employment. You can definitely, retire at age 60, not claim Social Security until age 70 to kind of maximize that benefit. That just means you need to plan to take money out of other accounts to kind of fill that gap in the intermediate years. I'd encourage you to go to ssa.gov and understand what your Social Security benefit is expected to be. You can look at a benefit statement as well as kind of play with different earning scenarios and see how that would affect your Social Security benefit. And once you start earning Social Security, then you'll get a yearly cost of living adjustment. And also the number that's on your benefit will continue to be inflation adjusted as well. So what's on your statement is kind of in today's dollars, if you want to think of it that way. And it'll be a higher actual amount to adjust for inflation when you get there. All right, are there any questions about Medicare or Social Security as we've gone through this? All right, we'll carry on then. Moving back to our chart here, we're now going to talk about this other portion, identifying the gap and using savings to bridge the gap. So when we're thinking about how much money we'll need in retirement, we want to figure out, so we figured out what our annual total expenses are in retirement. And these don't have to be the same every year, but this is just an illustration. Then we want to figure out what kind of our reliable annual income is. This could come from annuities, pensions, Social Security, some combination of all of those. And if there's a gap between what we want to spend and what we're going to get post-tax from all of these reliable income sources, then we have this sort of gap that we need to fund each year. And we're going to do this by pulling money out of accounts that we've been saving from for years. So while we're working, we have the goal of kind of accumulating enough money to have a good retirement. So what you'll want to do is factor in some kind of rate of return for funds that you still have invested. This generally is going to be a lower rate of return than in your early working years because you'll have a more conservative portfolio. And then think about, if you're drawing $30,000 a year off a $384,000 portfolio, and you need it to last 25 years because that's how long you're expecting to live, then you can put in a rate of return. There's a lot of financial calculators online that you can use to do this kind of analysis. It's called a time value of money calculation. And then, you can see if your assets last that whole period of time and kind of get at least a ballpark idea of how much you need or if you're able to retire on that then. So Back to general considerations, we want to think about, and this is very much from a tax point of view, which accounts we have access to. Pre-tax, Roth, and taxable accounts are the main tax classifications of different accounts. We want to think about our withdrawal rate and which order we want to withdraw from those accounts. And that's not always a straightforward, like this account, then this account, then this account. But you'll want to think about it in terms of, avoiding higher tax situations. Sometimes it can even increase the cost of Medicare for you. And then you'll want to think about investment allocation and strategy, how much cash you need and when, the time horizon for your funds, and what your risk tolerance is for seeing market fluctuations. This can often be pretty different for people in retirement than it was during your working life. While you're earning an income, your risk tolerance might be higher, and it might be a little bit lower when that's the money that you have to live off of. Required minimum distributions is another thing you'll want to consider. So this is distributions that eventually the government makes you take out of pre-tax accounts that you haven't paid taxes on yet. Eventually the government wants to get those taxes, so they force you to take money out of those tax sheltered accounts. These don't happen for Roth accounts, but they will with pre-tax accounts. And then, ultimately, you do want to make plans for all of these things, but periodically you'll have to adjust to changes that come up. Life is unpredictable. Plans will not look the same 5 years in the future from any point in our lives. Like, things change very quickly. So you do want to have strategies and implement those strategies, but you're going to have to go back and evaluate them. So either doing some kind of an analysis yourself, maybe yearly or every couple years, or decide to work with a professional is another option. So thinking about where we can pull assets from in retirement, the big types of retirement accounts are going to be your employer accounts, like your 401k, 403b, 457s. There is also non-employer type retirement accounts. These are IRAs. And then you'll also want to think about the aspect of, are you taking it out of Roth, where you're not paying taxes on it in retirement because you already paid taxes on that money when you put it into the account, or are you taking it out of pre-tax and having to pay the taxes to get that money out? There's also pensions, annuities, or other insurance products that you might be able to pull money out of, as well as your taxable accounts. If you have a taxable brokerage account or bank accounts, those are other good assets to pull out. So thinking about what to do once you stop working with your employer-sponsored plan, while you're working, you'll want to take advantage of your employer plan. You're generally getting benefits like matching money or employer contributions, as well as having pretty high contribution limits for most people. So while you're still working, make sure to participate in that employer plan. They're great deals while you're accumulating money. You can get that, make sure to contribute at least enough to get the full employer match. And then as much as you can after that. In 2026, you can contribute $24,500 if you're under 50, or $32,500 if you're 50 or older. And after retirement, you'll have a choice. So like I said, the employer plans are great while you're contributing, but once you reach the time where you're not contributing to them anymore because you're no longer employed, you can choose to keep your money in the 401k, 403b, 457 plan. And you'll still be, part of the plan the same way that you were, but you'll kind of be less engaged with the employer. Often these types of accounts are not set up as well for distributions. So just understanding what the process is for getting money out is important. Another option that tends to be good once you're no longer earning income, there are exceptions to this, but you can roll it over to an IRA or Roth IRA. So you can roll over the employer plan to a non-employer type retirement account. Make sure when you are doing these sorts of rollovers, a lot of people will have mixed accounts, some pre-tax, some Roth. And so you'll actually have to make sure that the account is split and because with 401ks, 403bs, they can kind of be a mix of pre-tax and Roth. With IRAs, it's not like that. They have to be separate accounts. So you want to make sure the pre-tax portion goes to pre-tax and the Roth portion goes to Roth to avoid any unintended tax consequences. If you were to accidentally take pre-tax money and put it in Roth, that could be counted as a conversion, and that may be all taxed to you as income this year, which is not something you would generally want to happen. IRAs are also can be nice because they give you more control over your investments and distributions. They're often on nicer online platforms. You can, usually pick one of the big three like Vanguard, Fidelity, Charles Schwab. All of those, it's very easy to set up recurring distributions from those platforms. And it gives you a lot of control over tax strategies. Some things like Roth conversions, which I talked about as a bad thing earlier if you're accidentally converting. But it can make sense in your early retirement years, certainly, to pay taxes on money right now to move them from pre-tax to Roth, especially if you're likely to have large required minimum distributions at some point in your life. That can push you into a higher tax situation. So converting money before Social Security starts, but even especially before like required minimum distributions start, it often makes sense to use those lower tax years to convert some money to Roth. Another thing you can consider that is specific to IRAs is qualified charitable distributions. So once you do have required minimum distributions, you are able to satisfy them either by distributing money to yourself and paying taxes on it, or by giving money directly to charities. So if I, had a required distribution of $40,000, I can pay taxes on that $40,000 and get it, or send that $40,000 to a charity to satisfy my distribution for the year, and then I don't have to pay taxes on that money. So if you're charitably inclined, that can be a very appealing strategy. So one thing we do want to think about, well, a couple things actually, is are we withdrawing too much of our accounts, and understanding the tax impact of withdrawals. So this is pretty important throughout retirement, but we kind of want to make sure we're on, as we're thinking about preparing for it, what do the early years look like? It's harder to plan specifically for the later years because we don't know exactly what life will look like then. But do think about, do you have a sufficient buffer in your portfolio? Remember that if your portfolio decreases by 50% because we have a really bad, market event, then you would need 100% to get back to the portfolio that you had before. So in those years where, there have been losses, that can be a particularly hard thing to recover from if that's early in retirement and you don't have safe assets set aside to kind of weather that storm. Thinking about sustainable withdrawal rates, if you're looking at a pretty standard retirement time frame, you can maybe think about taking 4 to 6% of your portfolio per year. If you're looking at a longer retirement, this number should be a little bit lower, probably even. But I think the 4% rule is a pretty good benchmark, especially when you're thinking for, you know, am I saving enough? Am I kind of getting to that point where I can think about starting to retire? And some people will be trying to just live off what their portfolio is generating. Some people are more okay kind of dying with zero, aiming to use their assets optimally to live their best life in retirement and don't mind if it's drawing things down. So just remember that if you're, especially if you're thinking above the 4% withdrawal rate, you will want to be a little bit more flexible in years where there is down markets. So you can get a higher withdrawal rate, but you need to be a bit flexible in bad years if that's the case. So just a general withdrawal order that usually makes sense. Again, every situation is different. But starting with your taxable assets, so spending money from bank accounts, non-retirement taxable investment accounts is generally the first place you want to take money from. Save money in those tax-advantaged accounts, and then you'll move on to taking money out of your pre-tax accounts. So that would be your pre-tax 401k, traditional IRA, etc. And then finally, generally speaking, we leave money in Roth accounts the longest. Those don't have required minimum distributions. They're also really good assets to pass on to heirs because they also won't have to pay taxes on them. So generally, we're trying to save those as long as possible if your goals are, sort of traditional and you're trying to have assets left over for your heirs especially. So thinking about how we should invest as we're moving from the accumulation stage of our portfolio to distribution, we do want a plan that takes into account money that we need in the short term. Kind of the best case for funding expenses today and tomorrow is cash. But as we're thinking about things longer in the future, once you retire, you still probably have expenses that you need to fund, 20, 25 years from now. And so you will want to think about maintaining some sort of growth aspect to your portfolio as well that will keep up with and hopefully even outpace inflation. So do think about what your allocation should look like to kind of cover those short-term things while maintaining some growth. Bonds provide kind of stability to a portfolio, and equities provide longer-term growth but are riskier for funding short-term expenses. I'd say it's kind of the opposite when you're thinking about things far out in the future. Equities tend to be better at covering those expenses. Because they tend to keep up with inflation well, and then having a nominal rate of return that's stable that bonds give is a little bit less important for those longer term expenses. So, as far as a portfolio, you want it to provide stability for those shorter term expenses and keeping pace and trying to outgrow inflation even with those longer term type expenses. So, depending on your risk tolerance, these are a couple portfolios that might be appropriate, like 50% equities, 45% bonds, 5% cash. Someone who has higher liquidity needs in the short term, maybe they want to do a large house renovation or want to travel a lot early in retirement, and that'll be quite expensive. Maybe wants to go even down to like 30% equities, 60% bonds, 10% cash. And as you're moving throughout retirement, you will want to review and adjust these things as well. And this kind of makes sense, right? If you're saving a portion of safer assets to fund shorter term expenses, as you get through those shorter term expenses, you can put a little bit more risk back on the table, as maybe you complete that house renovation or whatever the shorter term expenses are. This is kind of a good reminder. We love target date funds during the accumulation stage. They kind of do all the right things for you and make things really easy. But as you move on to retirement, generally we prefer different investments. I personally really like to move on from target date funds to something that's pretty similar, but they're like asset allocation funds. And they just kind of are one fund that's a well-diversified portfolio of, like 60% bonds and 40% stocks, or 60-40 or 80-20 or whatever's appropriate for your risk profile. But they don't get more conservative over time. They just kind of maintain that risk profile. And I think that that's a very helpful tool to think about the buckets of time where you need to fund expenses, and can kind of have that portfolio all managed for you without needing to do a lot of tinkering or rebalancing yourself. So something else that we want to look at, this is definitely not right for everyone, but all products have their place. Looking at sort of permanent life insurance policies, as well as annuities, is something else that you can consider. These are insurance contracts between you and an insurance company, just like you have with anything else. An annuity insures you against outliving your money. And an annuity is pretty similar to a pension. You pay either premiums to them, or this can just be a lump sum of money as well. And then they promise to provide you benefits for the rest of your life or the rest of you and your spouse's life. So these can be helpful for providing a stream of income very similar to a pension, but you can just get it from the private sector by kind of pooling your risk with everyone else of outliving your money. And then kind of what happens is those who end up dying early end up funding the benefits for those who live longer, just like with a pension. One thing to consider, though, as you're looking at, with insurance companies love to sell you more and more complex products because that's very profitable for them. So again, these products have their place, but be aware as you're looking to add extra features or riders, these are either going to increase the cost or they're going to decrease the benefit that you receive. So just be aware that there's a cost to all of those things. One thing you can sometimes add is like leaving money to beneficiaries, making sure that even if you die early, there's some kind of payment after, or inflation protection, which I actually think inflation protection is usually something I would want on an annuity, but it's going to cost you. It costs more to make that on there. And just thinking about these are not meant to be investment products in the same way that your retirement plans are. They are more expensive. Think of it like an insurance product and what you're insuring against. They're not there to grow your wealth. They're there to help you limit risk in a certain way. So make sure that you view them that way. Now looking at required minimum distributions. So the way that required minimum distributions work is once you hit age 73, or depending on your age, 75, you will have to start taking out money from your IRA or 401k or 403b accounts, anything that's in that pre-tax bucket and isn't Roth money. You'll have to start taking out a portion of that money each year. And starting at age 73, you would have to take out about 4% of the account value. Basically what happens is you have this factor that goes down a little bit every year, and you divide what your account balance was on December 31st of last year by that number, and that's how much you have to take out. And as you progress throughout your life, this number will go down, making you take out a larger and larger percentage each year. And that's going to be taxable income to you coming from a pre-tax account. So if you're born 1960 or after, it'll be 75. If you're born 1959 or earlier, then it'll be age 73. Remember, this is one of the places where qualified charitable distributions can help. If you're charitably inclined, if it's not a goal to give to charity, this is not helpful. You won't come out ahead by giving the money to charities. It's better to pay the taxes. But if you want to, you can give the RMDs directly to charity, and then you don't have to pay taxes on that money. That satisfies your distribution. So yeah, okay, so we covered, so all the money that comes out of these accounts is going to be taxed as ordinary income. This is different than if you had money in like an after-tax brokerage account. That would be taxed at capital gains rates, but all of this income and growth is something you haven't paid income taxes on yet, so everything's going to be taxed as ordinary income. And you can usually have it set up just like with your paychecks to have money withheld for taxes. And then if you're looking to take money out of these accounts, well, at least with 401k, 403b, and IRAs, there are early withdrawal penalties before 59 and a half of 10%, which is something you want to be avoiding. If you happen to have a 457b account, these don't have early withdrawal penalties. So that's kind of a benefit of that type of account. And those are available to some hospitals and government type organizations. All right, so that section was a lot. What questions do you have about cash flow planning, investment allocation, or taxes? All right, we'll just proceed on through then. Taking a look at estate planning before we kind of wrap up. But it's a very important topic, and if you haven't taken care of it before retirement, I definitely think you should take care of it in retirement. It can be an uncomfortable topic to think about death and end-of-life care and all those things, but it's important for several reasons. One is, kind of making sure that the things that you want to have happen, accounts go where you want, you get the care that you want at end of your life. The other thing is that if you haven't really laid out what you want to happen, this can kind of be a thing that destroys your family when there's uncertainty. Kind of everyone tends to assume that what they want to happen is what should happen. So it can be very hard on your family. So make sure you go through and create wills, which kind of for anything that goes through the probate process will decide how all of those assets are distributed. Power of attorney allows others to make decisions for you when you're no longer able to. Set up trusts so that assets in them will be distributed as you'd like them to. And I think something that often gets missed is healthcare directives. This is a document that has you go through and answer questions and make it clear to medical professionals and your family how you would like end of life care, if there's times when you would not like your life to be saved, or situations when you'd no longer like to continue living, how much pain you're willing to put up with to continue living, things like that. Those can be extremely hard decisions for your family to make if you haven't kind of had those conversations and solidified that ahead of time. Make sure to add beneficiaries on accounts. With retirement accounts and insurance policies, this is kind of the easiest thing you can do. You can literally just go in and change the name of who gets the account at any time. And this actually overrides the probate process. So whatever your will says is not going to affect what happens to a retirement account if you have set up beneficiaries on the account. If you aren't aware that you have an estate plan, you actually do have an estate plan. It's the default one that your state has. So if you don't have a will and die, it'll go through the probate process and kind of just by whatever laws the state has set up, which may not be what you want. Do note that I'm not an attorney, so this is very general advice. And if you have more specific questions on these sorts of topics, do go consult a professional who it's their job to do estate planning and understand the laws around that, especially for your state. Estate planning varies so much state to state. So do go through, make sure you have, especially retirement accounts, set up with the beneficiaries that you want. These accounts do avoid the probate process. You can name individuals or charities as beneficiaries of accounts. You can often set up TOD or PODs on other types of accounts so that they go directly to who you want as well. This is a little bit less common, but you can do it. And this sort of avoids the lengthy probate process and lets people get access to your assets more simply upon your death. So this would be, checking accounts, savings accounts, taxable brokerage accounts. Either having those things in a trust or having a beneficiary set up is a very nice thing to have for those who will be receiving those assets. It is really simple to update these compared to every other type of estate planning that you can have done. So I'd encourage you to kind of review who your beneficiaries are on all your accounts. Another thing to consider, which really makes you want to pay attention to these accounts and who the beneficiaries are, is sometimes life circumstances change. I'm thinking especially around like having children, as well as marriage or divorce may change who these people are, and they don't have the protections of the probate process. So especially if you've like been divorced, for example, you probably don't want your employer plan to go to your spouse, your ex-spouse. I mean, maybe you do, but because these things kind of just happen without any oversight, you really want to make sure the beneficiaries are the right people. So just to summarize, we talked about retirement expectations. What do you want retirement to look like? How long will it be? How much money do you need? Where will the money come from? Retirement income sources, as well as Medicare and covering medical costs. So Social Security and understanding other sources of income you have that maybe everyone doesn't have. Thinking about withdrawals and investment allocation. You're going to want to figure out what for you is the right balance of short-term needs and long-term growth in your portfolio. Consider how much cash you need and when, time horizon for your portfolio, how much stability you need to stay sane, and keeping pace with inflation to fund some of those longer-term expenses. Before you retire or in early retirement, I definitely encourage you to get some estate planning done. And you may even have benefits through your employer that make this cheaper for you. That's how I got mine done. There's just a legal service I can sign up for my annual benefits, and they cover estate planning costs for me. So that's something you should definitely look into if you have access to a benefit like that. All right, that's all we've got for the presentation for today. I'll stick around for a few more minutes if anyone has any questions. And other than that, you have a great day.